Should I buy now or wait? This is the number one question I have been asked this entire year. And today I'm bringing John Meussner back for another in depth interview to look at what the market report cards look like for a few cities here in Northern Virginia and to go through an actual analysis of what the cost of waiting is. Be sure to stick around until the end because we're also going to be looking at inventory levels here in Virginia and across the United States currently versus pre pandemic. John, it is great to have you back. Thanks for making time for this. I am excited to see these real estate report cards and hear your take on the market.
Yeah, it's always a pleasure to talk with you. And you're in a market that's kind of bucking the trend on the national headlines, so it'll be fun going through the data.
The headlines recently sort of make me raise an eyebrow, especially with our market and the talk of so much inventory, which is just simply not the case here.
Yeah, inventory's up. It's a buyer's market again.
Yeah,
Sellers are just
so I
giving stuff
read.
away. Nobody needs, as of next week, nobody needs a buyer's agent anymore. They work for free. Like there's so many great headlines for home buyers, right?
Oh, you gotta love the clickbait.
Yeah, absolutely.
I would say let's start with Alexandria. That is definitely a hot market, at least from the buyers that I have recently worked with. And as you know, you were a part of us being the winning bid, and it's competitive out there.
Really competitive. And yeah, so what I'll do then is I looked at some data for Alexandria, Fairfax, and Arlington.
Okay.
Um, what I found, it's important to mention the three different markets, but what I found is that they're all very similar in what they're seeing happen. And that's not surprising. They're all in the same general major metro area. So they're all similar. I'll go into a really detailed breakdown on Alexandria's numbers and then just kind of show the numbers for Fairfax and Arlington.
Okay.
And then we can just talk about just really what an opportunity people have, both homeowners and people looking to buy and make the leap into home ownership this year.
If
So
somebody watching is curious about a different market that we aren't covering today, still Northern Virginia, but a different city, can they reach out to you to get some more information?
100%. So what
Okay.
I'm going to show is available in um, every market in the country, I would say, with certainty. In certain markets, it breaks down to even a zip code level. Some are county level, and some are more broader, major metros. But we have good data available throughout the entire United States.
Okay, great. So anybody watching, if you are interested in a different market, doesn't even have to be Northern Virginia, you can contact John to get more specific information, and I will include his contact info in the description below.
All right, so I'm going to share my screen and we will just walk through what we're seeing in Alexandria. So it's interesting because I am physically located in California, and I recently saw something that showed we have like half of the markets in the US where the median sales price has eclipsed $1 million, which is kind of insane to think about. But
It
Northern
is.
Virginia is there as well. You guys have joined the party. So Alexandria median price is a scary seven-figure number now. So that's great for homeowners. But we'll see why that number isn't really that scary when you consider the broader market over there. I always like to start with the forecasted appreciation. So this is, to me, the biggest financial reason to own a home. It's the biggest financial reason to buy sooner than later, because the earlier you get in, the more of this appreciation you're able to capture faster. So in this market, it's expected that home prices, even though they've eclipsed a million, they're expected to continue to climb. So we're expecting about 4% over the next year. And you can look over 2 years, you're looking at 7+%. Now, these numbers could also change because if rates dip, we're going to take a look at both supply and demand. If rates go down, which we believe they will, it's going to bring more buyers to the market. It could increase the demand side. And we'll take a look very shortly at where supply is. And the imbalance could cause these prices to go up a little bit more. I think there's more likelihood that these numbers will be higher than any likelihood that they'll be lower. So kind of
Makes
go
sense.
through and break that down. And I always like to ask, because you're there. This is your market. You know this market inside and out. Do these numbers look fairly accurate as far as median price and historical appreciation and those types of things?
Yes, I would say if anything, especially in the last couple of years, the appreciation has been higher. Median sale price is spot on right now.
Okay, perfect. So Yeah, and we have to consider, so like 5 years, this does include, going back to 2019. So in 2019, you had a relatively stagnant market. And then 2020, 2021, things skyrocketed. 2022, they slowed down a little bit. So this almost 6% is incorporating all of those things. And then when you go back 63 years, the one thing I love about this is it incorporates that crazy, crazy growth we just saw, but it also encapsulates the crash of real
Yeah.
estate. So it's like it just kind of shows that over time it just keeps climbing like slow and steady, and it outpaces inflation, which is why homeownership is such a good hedge against inflation for people.
Safe long-term investment.
Yes, and one of the safest historical investments. I mean, even people that bought homes like me at the peak of the market in 2008 and very quickly realized what a mistake that was at the time, got it all back and then some. As long as,
Yeah.
buy and hold, real estate's a pretty good investment. The old saying, they're not making any more land. Like,
They sure aren't. And
so
Northern Virginia is definitely built out. They build on every piece of land they possibly can.
yeah, and that actually takes us into the supply demographic side of things. So if we go down here and we look at the supply, there's about 800 homes being built in Alexandria, and it's 800 a year, which that's a lot of homes. But when you look at the population demographics, it's nothing. It's not going to put a dent in what's truly needed. And this also, it's important to note, this isn't 800 single family homes sitting on an acre of land. This is condo communities, single family homes, duplexes. This is everything that they're working on. And month over month, you can see the inventory has dipped. Year over year, it is up 17%. It's also super important, though, when you look at year over year percentage numbers, and I shared this in my newsletter that I just sent out. It's like if you look at these percentages and these big percentage jumps, you're comparing it to a point in time when there was like literally no inventory.
Right.
So if you have a one home for sale and then you have two homes for sale, your inventory has jumped 100%. Well, 100% sounds like a huge spike, but the reality is in that situation, it's just one home. And that's what we're seeing. So when you see 17%, big number, but it's 17% increasing from like next to no inventory. And so it's
Not as
important
good as it
to
looks.
no, no. I mean, percentage wise looks great when you actually look at the physical numbers and compare it to what we're about to get into. It's inventory is ridiculously tight there, which is why it's expected homes are going to continue to climb in price. So the median household income, it's important because you need a high level of income to sustain these home prices. You get into these mortgage payments that are five, six, $7,000 a month. You obviously need a high level of income to afford and sustain that. So it's important to have a median household income that's in this range. It's more than double the national average. So it's an affluent area. Anybody living there is well aware. And the affordability index is a little higher than we'd like, meaning it's not as affordable as we'd like it to see. If it's at 100, it means that the median income can afford the median home. It's a little below that, but not much. And you can look and see it's actually more affordable than if you go back to like '04 to '06. And the reason is incomes have climbed and home prices have climbed as well, but the home price tag on the home doesn't matter that much because your mortgage payment is just a small percentage of your gross income. So like a big climb in home price, you're leveraging most of that increase through a mortgage payment that on a monthly basis isn't climbing quite as much or having as big of an impact. And this is going into this next section here, the demographics, when we focus on supply is, this is what I look at more than anything else. So when you look at the demographics by age, I always look at this 27 to 35 group. And that is because, why is that group so important?
First time home buyers.
First time home buyers. So historically, that is the age range of when people buy their first home. And you can see that is the largest
Yeah,
population
look how
segment
many.
in the market. And so this is nothing but a drain on the limited inventory. So you have over 30,000 people in this age group of first time home buyers, and you have 800 homes being built. So I don't know how they're going to squeeze 30,000 people into the 800 homes that are coming to market as new listings, but they're going to need to, or prices are just going to climb.
Yeah, because they don't have
And
anything to sell.
yeah, there's just nothing. So people are going to have to kind of go further and further out, living in more inconvenient places, or spend more money to get into these more convenient places like Alexandria to live. This other group The second largest demographic segment, 45 to 54. This group is interesting because what's cool about this market is that this group is often the people that are starting to become empty nesters, the people that are starting to want to downsize. And so they're putting their homes up for sale, and it's opening an opportunity for this group to buy those homes. So the fact that this group often makes moves as well. So this group should help to bring some additional inventory to the market once they're prepared to give up their 2.75% interest rates. And we're going to need some help from the interest rate markets for that to happen. But we
Yes.
should see some sales from this group that will help absorb some of the people wanting to buy homes from this group. When we look at homeowners and renters, this is really important too. You have almost 90,000 people renting, which is a huge, huge market. And of those people that are renting, 22,000 of them can afford to purchase. So if you put all 22,000 of those people in a room and you go over some of the data that we're about to discuss and that we're diving into, at the end of that meeting and presentation, thousands of those people would say like, hey, I should probably buy right now because the data supports buying as a financially rewarding move. And if we get in sooner than later, long term, we're going to build a lot more wealth and see a lot more financial opportunity. And again, if all 22,000 of those people or a segment of that all started going after those 800 homes per year that are coming to the market, it's just going to drive prices up.
Yeah.
So that's what we're seeing in Alexandria. We're seeing a market where inventory is climbing year over year, still super tight. Population is supporting a lot of first-time home buyers. A lot of those first-time home buyers have money and they can afford it. Even if they see some sticker shock on their mortgage payment, they're still able to get in. And frankly, I mean, you can tell me because you would know this better than me, but like in this median price point of 1 million, let's say the 900,000 to 1 million price range, what are rents typically going for?
Single family in that price range, depending on where in Alexandria, anywhere from 5,000 to 8,000.
So you're looking at a mortgage payment to rent, and the difference is if you're renting, guess how much of that 3.78% appreciation you're getting?
Right.
Zero. Guess how much your landlord's getting? All of it,
Paying
100%.
down their mortgage.
100%. And so this market is, I think this market just looks very healthy. The nice thing about this too is when you see this 4% range of appreciation per year, that's sustainable. It's outpacing inflation right now. Obviously, inflation was much higher 2 years ago, a year ago than it is today. Inflation's finally down into the 2% range. So this is a good hedge against inflation, but it's also sustainable. These 4% figures, people are getting raises still. The jobs market in this place is actually unique in a sense that if you look at the whole country, the two industries that have seen job gains, even recently, as employment nationwide has started to sputter a little bit and unemployment has spiked, in Alexandria, you have a lot of government jobs.
Yeah.
And the greater DC market, you have a lot of government jobs. And the two industries that have really flourished have been travel industries like hotels and government jobs. Huge, huge segment of these jobs reports and the job gains that we've seen over the past year have been government jobs. And so being in an area that is full of government employment is really beneficial long term for the market. Those jobs aren't going away. So it's
We always say we're in a little bubble here. Even when the market crashed, immediate Northern Virginia inside the Beltway really didn't get hit all that hard. We're
mhm.
protected. The government's not going anywhere.
Yeah, and the government typically doesn't do, they're not doing layoffs. It's very, very difficult, at least the friends that I have that work in government roles, it's pretty hard to get fired in a lot of government positions. So I say that just to emphasize that there's a lot of job stability. So even though the
Yeah.
incomes are higher, these are stable jobs too. So this income is going to see year over year raises, increases in pay that are able to support these increases in home values. So it's a safe market, it's a stable market. And the good news is, if you're a homeowner in this market, you have gained so much in appreciation since
Yes.
2020, 2019. You've seen values consistently climb. And so, you have an opportunity to really to cash in, whether you're downsizing or you're considering moving to another market. You likely have a ton of equity that even with higher interest rates currently and home prices being higher, if you're in that position where you're downsizing or moving to a more affordable market for your long term, you probably are going to have a boatload of cash that you can use to,
Yeah.
even with higher rates, to end up in a really, really good position. with your move. And as a home buyer, you still have a lot of runway. So even though you missed that huge equity run from 2019 through today, you still have a lot of runway to build your net worth through owning a home if you get in today. Because if you don't buy that $1 million home today, it's going to be $1,050,000
Yeah.
a year from today, almost $1,000,001 2 years from now, and then you're going to eclipse $1,000,001 3 years from now. So again, you still have runway at that point, but the runway is a lot longer and looks a lot nicer for long-term wealth building today.
Yeah, I think it's very eye-opening to see that even if you just go out to year 3, that's a lot of equity to build in a short amount of time. I don't know
Yeah.
many people that could save that much money in that amount of time.
I mean, if we just look at the numbers, yeah, it's $112,000
Yeah.
in, real money. So break that down, you're saving over $30,000 a year. It's $3,000 a month. I don't know that many people that can just put $3,000 a month in their savings account every month.
No,
But
myself included. I couldn't do that.
yeah, but if you own a home, that's pretty much what you're doing just
Mhm.
by sitting in the house, living in it, and making your monthly payment.
Yeah,
Um, and you've got to live somewhere. So if you're renting, you're doing the same thing. You're just not getting the benefits. And we're not even getting into tax benefits and some of the other ancillary benefits today. But
that's true.
there's some other perks too that make this look a little better. And so this report, before I go into any of the other markets, any other commentary or anything on Alexandria?
No, I think it's spot on. It's very telling to what I see, just boots on the ground working with buyers and sellers on a regular basis. I can't even tell you the last time in Alexandria, with the exception of condos, that I haven't been in a competitive situation, whether it's on the buy or the sell side. Years.
Yeah, we've seen that locally too. You have to get creative in your offers. You have to work with a team through
Yeah.
both your buyer's agent and lender that can proactively reach out to the seller side, can communicate, can put together a competitive offer, and maybe be a little bit creative and stand out from what some of the other folks out there are doing. It's definitely not as easy as just sending over a completed contract and waiting
Not
for the
at all.
acceptance. And then we have some other tools too for anybody that's watching. Like we have bid over ask calculators that take appreciation into consideration and how long you plan on living in a home that will help you make a smart decision when you are crafting an offer on a home that you want to buy in these markets. So we can show people that we're working with that stuff as well. So that with that, I'm going to go into Fairfax, and there was more limited data here, but again, very similar marketplace. Can you provide a little bit of commentary on, so the median price point you'll notice is a lot lower, even though the appreciation forecasts percentage wise are a little bit higher than Alexandria. Can you kind of comment on the lower median price and just provide some background as to, like, let's say that $1 million price point is a little out of somebody's range. What is the difference in the two markets that would account for the slightly lower prices in Fairfax?
Alexandria is extremely close to DC. Both Alexandria and Arlington are highly sought after because of proximity to DC and also access to Metro. Fairfax is a little bit further out, not saying you're going to have an hour and a half drive to work, but you are, if you're driving into the city or the Pentagon, you are probably going to be looking at 45 minutes to an hour. And Metro is not nearly as accessible in Fairfax as it is compared to Arlington and Alexandria. So that impacts median sale price.
And it also is indicative of a market where if you probably get a little bit more benefit too. Is there like maybe a little less traffic, a little more space in the
You're
Fairfax
definitely
area?
going to get a little bit more space in Fairfax. You're going to see bigger lot sizes. Not that they're going to be huge, but bigger by Northern Virginia standards. And you're also going to find more townhomes and single family homes available in Fairfax than you are in Arlington and Alexandria.
And so that might be perfect. And the reason I ask is like somebody that's looking or moving to the area from another place and they're considering the different markets. So I mean, you might sacrifice in one area, right? Your distance to things, your commute. But for somebody that's working either partially remote or fully remote, or somebody that just wants that extra space and they're willing to exchange a slightly longer commute for some more space, again, good market to consider then. And the appreciation is, again, forecast to be sustainably increasing. I think anything over like 6-7% that's where you start like outpacing incomes and wages, and then you get a little bit scary and it starts to look like a bubble's forming. those 10% plus
Yeah.
appreciation rates we saw in 2020, 2021, that was like, this needs to stop because it's not sustainable. These 5.5% numbers are way more sustainable long term. So we don't have as much data for Fairfax. If I broke it down into zip code and just expanded to a larger county level or nearby counties, we'd have some more data. But the takeaway is similar. The demographic numbers, when I have done some more localized county stuff and some more expanded searches for Fairfax, all of the numbers and things in terms of demographics and inventory have kind of aligned with what we saw in Arlington. So not going to spend a ton of time on that or dig into too many market details, but very, very similar market to Alexandria, rather. Alexandria, but again, slightly lower median price and also a healthy appreciation forecast. Then we got Arlington.
Coming in hot.
Coming in very hot. If you look at Arlington, this median price is higher than Alexandria.
Yeah.
Alexandria was pretty high at 1.01 million. We're at 1.06 if we go into Arlington. But if you look at the appreciation numbers, they're still looking pretty good.
Very similar.
Yeah, very similar. And you can see kind of like year 1 and 2, you're making a little bit of money. This market's really cool because, in lower priced markets, markets where you can get a home still for $300,000, 3-4% appreciation's nice. But when you buy a home, you have fixed costs. Your furniture, you're not paying for your furniture as a percentage of your home price, right? You're paying in dollars. When you pay your real estate agent, the title company, the lender, you pay all these things. They're in dollars. So you have to own a home for a couple years usually before you start breaking even in those markets. But in a market like this, I mean, you're up $41,000 year one. So, that exceeds those fixed costs. So you're pretty much made whole within a year of buying a home in a market like this, which I think is a phenomenal opportunity.
Yeah.
And the appreciation's very, very similar. If you look, I mean, I think what was it in Alexandria? 3.7?
Yep.
3.78. Forecast is 3.86. So the
Very
things that
consistent.
very consistent, and you kind of mentioned it right when you were explaining the differences between Alexandria and Fairfax. Seems like Arlington and Alexandria are just super, super similar markets.
For the most part, they really are. They're right next to each other too. And Arlington is highly sought after because it has the highest amount of metro stations out of any city in Northern Virginia. They also have very highly rated schools, particularly in North Arlington. And there is quite a bit of new construction for single family homes, mostly one-offs, but they're coming in at 2.25, 2.5 plus million. So that also drives the median sale price.
When you can actually see that. So there's a difference in the demand demographic from Alexandria. So if we go down a little bit, you can see the median household income is notably higher,
Very
but
much
the
so.
median sales price is relatively similar. And so for that reason, if we look at the affordability index, it's actually a more affordable market
Mm,
because the jobs are paying more there and the price point's similar. Now, again, we're including condos and some of the things that
yeah.
come with the seemingly, I always like to remind people like the price tag on the listing is cheaper with a condo. When you start looking at the HOA fees involved, there's often not a huge gap in your monthly output between the two. So you really have to consider those things when you're considering what type of property you want to buy. But we do have
Completely
more homes
agree.
being built. We do have more homes being built here. It was 800 in Alexandria, and we've got 1,400 a year in Arlington. But if you look at what's happening year over year and month over month, it's actually shrinking. That's a little bit unnerving I mean, just the potential for prices to go up and go up quickly and quite a bit
Yeah.
is there when I'm looking at these numbers. And the reason is, let's go back to the other area when we look at demand, look at the biggest demographic group by a long shot in
Lots of
Arlington,
first time home buyers.
first time home buyers. And I don't have the graphic in front of me, but I shared this in the newsletter I sent out Friday. And if anybody's watching, you can reach out to me. I do a weekly newsletter just with a market update. What did I mention? It's the largest percentage of people in this age range are living with their parents today than at any time historically since the 1940s. And so the demand is pent up. These people aren't living with their parents because they want to. They're living with their parents while they build their credit, while they save money, while they pay down their student loans, while they're waiting for rates to drop and affordability to get a little bit nicer. And this market is, again, you have this huge, huge, huge pent up demand. shrinking supply and a lot of people that can afford to purchase because of these higher household incomes. So
Hmm.
again, sellers, homeowners, if you are thinking about moving, look at these inventory numbers. Now is a good time. There's not a whole lot of competition, and it doesn't look like there's going to be for the foreseeable future. So, putting your home for market is, you've seen it locally, I'm sure. This looks like a good market to get top dollar for a home sale.
Yeah, I definitely had a couple clients right in Arlington and didn't get it. One example that you were helping us with, the house ended up going for 252,000 above list. And it was a nice house,
Oh,
extremely well maintained, but it wasn't updated or anything. It's
yeah.
extremely competitive.
Yep. And that's important to note too, because again, the renovations that you need to do to a home are in fixed dollars. So you're going to pay those fixed dollars. And I'm sure the person that bought the home looked at this and considered, like, we're going to pay 250 more to the home, but I'm sure they could probably put 100,000 or less into that home and see the value exponentially increase based on that investment. And all the while, the appreciation is going to continue to work for them. So if you're buying a home long term and you're buying that home to stay in it, 8 years plus, 10 years plus, you can spend a lot more than list price or a lot more than what comparables are going for, and still end up winning financially, even if it seems like you're overspending. So I always have to put overspending in air quotes, because I haven't had any customers that have ever overspent and lost in the long run. Everybody comes out ahead.
I think that's a really good point because I can understand as a consumer why it's hard to get past that. You see the list price and you're going, wait a minute, I'm bidding six figures above list. But in most cases in this market, as long as you're in it for the long run, you're always going to come out ahead if you're committed to the long term. If you're telling me you're going to move in 2 or 3 years and you don't want to be a landlord, then most of the time it doesn't make sense.
And again, it depends, because in this market, you are going to recoup costs very quickly. So 2 years plus, I think you can kind of anticipate looking at these numbers and just kind of knowing what we know. If you're going to live in a house for 2 years, that's probably going to be your break even point when you take real estate, transaction fees, closing costs into consideration. That 2 year mark is usually about where you're gonna break even, maybe a little bit before, a little bit after. But if you're staying in the house for 3 or more years, the odds are you're going to come out ahead.
Yep.
And the longer you stay in, the more ahead you will be. Let's talk about cost of waiting. I think this is one of our favorite conversations, right? It's like
Yes.
the people that are
I love this.
they're going to wait. They're going to fix their credit. They're going to save some more money. They're going to wait for the market to crash. I don't know when that's going to be, because year five, the market's going to go up 20,
The odds are not in
21%.
their favor.
It's going to need to take a real big crash to compensate for the 20+% gain we're going to see over the next 5 years. I always look at a 1 year time frame, because the people that are normally going to wait, not all of them, but most of them, are renting. And so you're usually going to do a 1 year lease on a rental. That's the vast majority of the rental market. So we always like to look at a year. And so what I did was just looked at what's going to happen over the course of a year. So
Okay.
we do expect rates to come down. We expect rates to come down pretty substantially, because this is my personal opinion, but looking at the market, I think the Fed has waited too long to start cutting rates. I think they've kept rates
Mhm.
too high for too long throughout the marketplace. We're already seeing some weakness in the jobs market, and I think that's going to accelerate. Now, your market's a little bit of a bubble, because you have that protection of the government jobs, and leisure and hospitality is that other industry that does really well. So you
Mhm.
guys have two of the more robust industries that are somewhat insulated from a broader spike in unemployment. But nationwide, that's what's going to impact interest rates. And nationwide, I think we're going to see unemployment go up. I think we're going to see the economy slow down. And I think the Fed's going to have like a uh-oh moment, where they're like, we got to cut more than we thought and faster than we thought. And that should cause rates to come down. So when that's going to happen, a lot of people thought it was going to happen kind of last year. I was in the group that kind of thought it was going to be a little bit earlier this year. And at this point, I do think it should have been. I think the Fed has kind of missed the boat on when they
Yeah.
should start cutting.
I was thinking earlier this year too.
And I think they're getting to it. The big forecast, the huge prediction is that it's going to be September. But what I like to remind everybody is that almost a year ago to the date of the last jobs report that came out, I don't think it wasn't Friday. I think it was the Friday before Friday of last week. So it's August 12th now. The last jobs report caused a rally in the mortgage bond market that caused rates to dip. And I went back, because I always do. I like to see kind of what trends we see seasonally. a year before, we kind of saw the same thing. Mortgage bonds had a rally, rates dropped, the home market got excited, and then we had a surprise inflation report that was higher than everybody thought. And we had a couple good jobs reports, and then rates climbed again to almost like their 8% peak.
Yeah.
So I'm not going to be really excited until it actually happens, until the Fed starts to cut. But it's expected that that could happen as soon as September 2024, which is quickly approaching.
Yeah, we're
Um,
getting there. A couple more weeks, right?
this year's flying, as they all do.
It is.
But so if we look at 1 year from now, and I say all that background because the payment difference a year from now is expected to be drastically more affordable, even with the prices of homes going up. The monthly payment, this is all due to what's expected to happen with interest rates. And 348 a month is a big deal, for a lot of
Yeah.
people. Gosh, I feel like not anymore, but it used to be a car payment. Cars, like homes, have also become a
Yeah.
lot more expensive. So we're seeing an awful lot of $1,000 car payments on credit reports these days. But 350 a month, that's, it's nothing to scoff at.
No, that's
But
still a chunk of change every month.
yeah, but when you look at it, it's $4,000 a year. That's a really nice savings. But again, look at the appreciation gain. You're just not, the market's not going to cooperate with you in terms of making you money. Because if you
Yep.
bought the house today, you would have $37,000 in appreciation a year from today. And your payment difference, you'd end up spending, $4,000 more. So you're going to win to the tune of 30K by buying now. And it's because
Huge difference.
the vast benefits through appreciation. And it's just simple. If you own a house, you get all of it. If you don't own a house, you get none of it.
Yeah.
Whoever owns the house comes out ahead. And so even if people have to stretch their budgets a little bit, and I don't want anybody to be house poor. I think that's a huge mistake when you
Yeah.
buy a home.
Never.
I have so many people that I talk with that, they say it because I never push anybody to push their budgets because I don't know what people spend on groceries. I don't know their lifestyle. I don't know how often you go out to dinners. I don't know those things. You do as a consumer. So I'm not going to push you to buy outside of your comfort zone. But I have people all the time that will say, even though the payment's high, when we refinance, we should be okay. And I'm like, don't buy. If that's your mindset, don't
Yeah.
buy because there's things that can happen. Life happens. You have to be comfortable with the payments today. But if you are, buying today makes so much more sense than waiting a year because
Mhm.
of this figure. 30,000 bucks. I mean, who couldn't use an extra 30K? Again, that's almost taking $3,000 a month and just throwing it into your savings.
Right.
We love looking at this cost of waiting because it's just eye-opening when you see the amount of money, like 3.78%. It's like, cool, what does that mean? But when it turns into almost $40,000, that's huge. And then again, this even factors in, you're going to come out 30K ahead, assuming you're refinancing to the tune of 4K in closing costs, if you even have 4K in closing costs, like lender rebates, those types of things
Yep.
also start coming back when we see the market shift and the Fed making money more affordable. So a lot of times we can do a refinance with even lower cost than this, but this assumes you're spending 4K on a refinance. You're still going to come out
Yeah.
ahead. And guess what? Guess what's going to happen to your payment when you refinance?
Exactly.
You're only going to have that extra 350 a month for the year until you refi, and then your payment's coming down too. So buying sooner than later it's just a smart move because again, the appreciation is so much more impactful than literally anything else you can do. And that
Completely
is,
agree. This really puts it in perspective. I think that's why this is one of my favorite tools that you use and share with clients because it really just shows you exactly what you're looking at instead of feeling like I'm overpaying or rates are high.
and that's the thing. Everybody wants to improve their position because they learn things, right? People learn things, but they understand snippets. They don't understand it in the full context of what home buying is and short term versus long term. And people think like, well, I know if I have a better credit score, my mortgage will be cheaper. Or if I have 20% down instead of the 10% I have today, I'll avoid PMI. And so they what is it like? What is the saying? Like people like step over dollars, picking up pennies or something like that. It's like I forget the exact saying and I probably just butchered it, but it's like
It's something like that. I was going to say
it's
penny wise and pound foolish. That's the one I
that's
know.
well that is the exact point is they're trying to save dozens of dollars a month or even hundreds of dollars a month. And in doing so and taking the steps to save hundreds of dollars a month, you're leaving thousands of dollars a month on the table and not even
Yeah.
realizing it. So this last one I did kind of speaks to that. So what I did was like I just looked at a person today whose situation needs some work. If they buy today, they're not in the optimal position. And then I just compared it to somebody that in today's market, they're ready to go. They've done the work. They've got the perfect credit. They've gotten a slightly larger down payment. You know, down payment's a huge thing for most people. And so the other
Yep.
thing I want to emphasize is that you don't need money to buy a house, at least sitting in the bank, especially to buy your first home. There's low down payment options. There's no down payment options out there in a lot of markets for a lot of people. But even standard mortgages, conventional loans, FHA loans, you need 3 to 3.5%.
Mhm.
And that's it. So you can buy $1 million home today with a $30,000 investment.
Mhm.
You can do that. So what I did was I compared two loans. And this one I looked at, I forget the credit score I used. I want to say it was 680.
Okay.
Pretty sure this was the 680 FICO score on the left here. And then person that already did the work, I did, I think a 765 FICO. So, you know, anything over 760 in the mortgage world is generally considered perfect. There's pricing adjustments every 20 points below that you go to both interest rate and mortgage insurance. So if you look at the two loans, this person had 3% down. This person saved up the additional money already. They have 5% down. So they're doing 50K instead of 30K.
Okay.
Because of that, this person has a lower rate. This person has a higher rate. We didn't put points into the equation because, again, we're just comparing apples to apples here, credit and down payment mostly. You can see the PMI for this person is substantially cheaper. When you talk about like the goals people have, they see they could save some money if they improve their credit because they'll save $170 a month in PMI. That's a lot of money to save. And when you look at the total monthly payment, it's a substantial difference. Person
Yeah.
one still has some work to do. They have averaged, you know, slightly below average credit. Maybe they've had a couple 30-day lates in the past few years. Maybe they have a collection that's hanging around and their credit score is just not quite where they'd like it to be. They are going to pay a premium in both rate and mortgage insurance. And maybe they haven't saved any more than that 3%. So they're going in with a higher loan amount at a higher rate with higher PMI. That does have a very real impact. And the person that's done the work, they're getting rewarded for that today. But let's say this person wants to become this person, and you look at the time it takes to get there. Call it a year. We're going to rent for a year. We're going to save up that additional 2%. We're going to work on paying down our credit cards or paying off collections and getting deletion letters to get them removed. And we're going to build our credit. And we don't want to buy until our credit is perfect because we know that there's this much difference in what we pay every single month. But again, this is, I'm going to try to do quick math. If I do the math right, this is about $350 more than 8,000. It's about 400 below. So we're going to call it 750 a month difference in payment just to keep it simple. Double check me there. Does that check out?
It's
About
close enough. Yeah, I'm not going to
about
get an exact number either. I'm not that good.
about 750 a
Yeah.
month. If I look at that over 12 months, what is that? That is about, I don't know, something like $9,000. If it's not $9,000, it's pretty close to $9,000 over the course of a year. So you do the work, you put in all that hard work, and you're going to be rewarded to the tune of about $9,000 a year. Guess what?
Yeah.
Doesn't matter. Doesn't matter because that's how much money you would have made by buying that house today, even if you're not in that perfect situation.
Yep.
And so you can do all that work. And we want you to. We don't want, I mean, I'm a
Yeah.
banker, but I'm not the bank, right? I'm not the person I'm not making money off the interest you're paying. I'm not the mortgage insurance company. I'm not making money off of you because you're paying a higher premium. I want you to have the lowest rate. In fact, that's like one of the things that we do through financial education is teaching people how to use the banking system and have it work for them. So we want you to save as much as you possibly can. We want you to be in the best position long term and short term financially. But again, being penny wise and pound foolish, you don't want to do all these steps to save that $9,000 a year at a cost of
Right.
$37,000 a year.
It's a
And
massive
so
difference.
again, there's so many people that have that mindset where they want to do all the right things and they want to be in the best position and they want to wait until they have the bigger down payment, the higher FICO score. They want to wait until rates drop to buy. Like we talked about in the very beginning, guess what? If rates drop, more of these 22,000 people that can buy are going to want to buy. And guess what? Alexandria is not going to flip a switch and turn that number to 5,000 homes. They're just not. Can't do it.
Don't even have
This
the land to do it.
this huge segment of people, many of them that are probably living at home, guess what? As soon as those rates drop and mortgage payments get to where they want them to be, way more of those people are going to enter the market. And so
Yeah.
that's why, I mean, we've been saying it for a while. Buying now is, if you can buy now, if you can afford it and you're comfortable with the payment, even though the sticker shock might be high and it might be, more money than you would like to spend, right? We all want our monthly expenses to be as close to zero as possible. But if you're able and you're comfortable with the payments and where they'd be and you have the money, buying now is, I think much smarter than waiting a year and getting all of your ducks in a row and making sure everything's perfect, because the market is just going to continue to run away from you. And
Yeah.
you're going to do all that work and you're still going to be financially behind the person that just went in and bought today.
It's very true. I don't know anybody out of my clients and sphere who has been happy they waited. They all regret it.
Everybody does. And, some people look at the inventory and they say there's nothing really for sale that we love. Well, again, if you get into a home that, I mean, again, I'm not telling anybody to like buy a house where you're going to be miserable. Or if you have like a
No, of
family of
course not.
six, I'm not saying like move in, buy that 2-bedroom condo anyway, and just stock up on bunk beds. Like, don't buy a place where you're going to be miserable. Like, but if you buy a home that maybe needs a little bit of work, maybe it's not perfect, again, you get in and you look at this appreciation ride
Yeah.
and either sell and then buy something new or renovate. And the renovation costs are probably going to
Yeah.
be in line with the appreciation that you're getting on the house. So it's, the home appreciation is offsetting renovation costs and other expenses that you have owning the home. So it's a wise move financially for most people. And your market is unique in that when we look at this nationwide inventory, this is something that's really interesting too, because in the media headlines, you see inventory is spiking. Well,
Yeah.
there's two things to keep in mind. Well, three things, because the first thing I'll point out is I couldn't find the most recent chart, but it's fairly close to this. This is March 2024, and we're recording this in August. So not that long ago, but not the most recent data available. Most of the headlines are comparing those inventory numbers to last year. And again, we're comparing it to like the lowest of the low. And so inventory has come up from then. But when you look at the last time we had what we consider a normal balanced market was pre-COVID. So late 2019 going
Yep.
into 2020. If we actually look at home inventory nationwide in July of 2019, and we compare it to the inventory numbers nationwide of July of 2024, it's a 30% dip. So we're 30% lower in inventory nationwide than we were in July of 2019, and our population has grown. The demographic of first-time homebuyers has grown.
Yep.
So there's 30% less homes for sale and more people trying to buy them. And so it's really important to take that context into consideration, because if you just follow the headlines, there's more inventory. Inventory is climbing, the market's
Yes.
changing. But if you go back just as recent as 2019, we're so far below those numbers. And the other thing I want people to take into consideration is that there's certain states that when you look at nationwide inventory numbers, these numbers that are seeing inventory climb substantially are being led by 4 states in the entire country. And
Correct.
I'm putting pressure on myself here to remember the 4 states. But I think based on the most recent numbers, I believe it's Idaho, Tennessee, Florida, and Texas.
Yep. I
And
read the
so
same thing.
and so if you look at, let's just use Florida and Texas as examples. Would I want to spend 6 figures over the median sales price in Tampa Bay right now? Probably not.
No.
Probably not. Inventory is climbing. You're probably going to have some opportunities as a buyer in that market in the foreseeable future. But then when you get up into the mid-Atlantic, you can see that the mid-Atlantic is an entire region from New York down really to North Carolina. Inventory spiked quite a bit in North Carolina too. Still, I think North Carolina is a wonderful market to buy in, with a very high quality of living. But Virginia to New York
Yeah.
is lagging behind the entire country. We've seen inventory either going down or not going up throughout the entire mid-Atlantic. So this is very, very regional. And even if you look on the West Coast. You might see inventory spiking on the West Coast, but look at Nevada.
True.
I've had
Number.
people get into some major bidding wars in Nevada, and it's just easy to see there's just no inventory.
What's
And
driving
so
the market in Nevada? Are a
a
lot of
lack
people
of inventory
relocating?
and a lot of people. So when you look at the state that it's next to,
Hmm.
I'm not, I'll just say I live in
Yeah,
California.
you live there.
I love California for many reasons. Some of the things that I hate about California are the just ridiculous taxation on everything.
Yeah.
We pay an awful lot in taxes. And if I were to move from my current home, I'm in Fair Oaks, California, about 20 minutes outside of Sacramento. If I were to move and buy the same priced home in Nevada, I'd probably save $6,000 a year just in property taxes.
Okay.
So, I mean, $500 a month just for crossing a state line.
That's a lot.
Um, Nevada has some beautiful places. There's a lot of places, again, like especially on the border by Lake Tahoe, a lot of beautiful, desirable places that are just more affordable. So you have a lot of people that have left California or some more expensive markets and have found that Nevada's a nice place to live. So there's a lot of demand and there hasn't been a lot of building and new inventory hitting the markets.
That's a big
And
number. That really surprises me. It's fascinating to hear what's causing it.
the other thing you have to remember about Nevada is like if you go into the mid-Atlantic, most of the places you can live in the mid-Atlantic, like you can put houses down in just about, I'm drawing a circle with my mouse here. You could plop a house down in just about any of, this area here. In Nevada, like this whole area is like desert. So
Yeah.
there's a more limited infrastructure. So there's just less places to live as well in a place like Nevada. You have a lot more desert. I mean, this whole area in the interior of Southern California into Nevada is just all it's Mojave Desert. So
Can't
you're not
build.
doing much building there.
Yeah.
So that's what's driving part of that. And I mean there is an exodus from California that is very real. You have some apologists for the state that are just like, oh, it's still a great place to live. Nobody's really leaving. But if you look at some of these numbers, like Texas, sorry, like you're Southern California now.
Yeah.
Um,
I know that from following another agent on YouTube. A lot of people from California moved to Texas.
A lot of people have gone to Florida.
Yep.
You want to leave California and get away from some of the policies in California, but you still want palm trees, sunshines, and oceans. Good place to go is right down here. So Florida is has become kind of Southeast California in that sense. That's a place where you can move and still have like similar quality of life, similar nature. I would miss the mountains, which is why again, I live in California for a reason. I love beaches, I love mountains, and I have them all here. And for now, I'm happy to live here. But that's why you see some of these discrepancies. But where you are, inventory shortage in the markets we just
Yeah.
covered, huge inventory shortage, and that's likely to keep home prices going up and just make the market good for people that are buying sooner than later.
It makes sense. I mean, even pre-pandemic, we didn't have a ton of inventory. It was much better than it is now, but we were still getting multiple offers in some cases pre-pandemic, especially on single family homes.
Yeah, and if you remember, rates started to drop. So if I go back to 2018, 2019, if I remember, rates had kind of spiked. We had saw like a little refi boom when rates went sub 5% for the first time in a very long time. And then rates kind of climbed. They went up to like the high fives, low sixes, and it almost froze the market. But then rates started to come down a little bit into those 4%, like 4.75, 4.875. And it brought a lot of demand. And what had happened, and I'm sure this is what happened in your market, and correct me if I'm wrong, but what happened in many markets is builders completely stopped doing spec housing
Yep.
after the crash. Like if you remember back in like 2005, 2006, builders, it was like if you build it, they will come.
Yes.
And builders were like, we're just going to drop 1,000 homes on this piece of land and they'll
So
sell
much inventory.
and they'll sell. And after the crash, they learned. So builders just weren't building like that
Mm-mm.
anymore. They were building single homes for people that were coming in with money. And you weren't seeing those huge development plots go up overnight.
Yeah.
And that was the case in 2018, 2019. We were still seeing the effects of the Great Recession and the housing
Mhm.
bubble collapse. COVID just exacerbated the problem because the
Yeah.
entire industry froze. People couldn't build. The supply chain dried up. You literally couldn't buy
Yeah.
homes because you couldn't get materials. Remember, the price of lumber spiked
Oh, it was
astronomically.
crazy. Even getting
Work
permits was way longer.
Getting permits was nuts. Government offices were closed.
Yep.
In some states, I remember Pennsylvania for a while. It took Pennsylvania a long time to make real estate legal to do.
Yes, they got completely shut down.
Yeah, you weren't allowed to show homes. It was funny. I had like black market real estate agents like sneaking people into properties because people need a place to live.
Yeah, people were still out wanting to buy and sell.
Yep. And so, yeah, it was a wild time, but we haven't had robust inventory since
Mhm.
the real estate crash 2013 2014, and it's worse today. It was climbing, and recovering, but it was still short of probably where we needed to be in
Yeah.
2019, and then just got worse. It took a nosedive through 2020 2021, and then we hit 2022 and it started kind of bottoming out. 2023 it started climbing, and so we're seeing it climb, but we're still just not to those 2019 levels, and we're well below. I have other charts that I could show people and illustrate these things, but we do have the data that shows both new household formations, which represents demand, the population demographic that are buying homes and absorbing inventory. And we compare that to inventory. And if you go back to like 2006, 2007, you had very low number of household formations and a sky high amount of inventory. And the chart, if you look at it today, is almost reversed.
Yeah.
You have sky high household formations or demand, and you have very little inventory available. So
And lower rates are not going to help that.
no, no, no.
Opposite.
When rates dip, I mean, even if rates dip, I personally think the magic number is going to be again when we get. I think a lot of people will move when rates hit the low sixes to the high fives. But I think if we break through 5% again and we start seeing rates in the high fours, because if I'm somebody that has a 3.25%, a 3.5%, maybe I didn't lock in when rates were at their very, very low. They were in the high twos there for a
Yeah.
while. If I didn't get that, but I got like low threes, mid threes, I'm going to trade that rate without much hesitation for something in the fours.
Oh,
Am I
absolutely.
going to trade that for a six?
Mm,
Depends on my situation, but I'm going to think about it a lot more.
yeah, you'd have to be pretty unhappy, I think, for most people.
Yeah. If I'm going threes to fours, though, I'm not going to think about it. That's
No.
whatever, negligible. And so if we get there, which I think we could, most people are forecasting, again, I'm an exception, I think, on this one. I think most people are forecasting rates are going to go high fives, low sixes, and kind of stay there. I have zero faith in the Fed's credibility to manage these boom and bust cycles at this
Yeah.
point. I've been through enough of them now, and I've seen these huge, huge swings in the markets and these crises that they create through both their actions and inactions. It's like they do the wrong, whether they're
Yeah.
acting or not acting, they're doing the wrong thing. And I just don't trust when they say they're going to navigate us through a soft landing,
I
because
don't either.
it's the same Fed that told us inflation was transitory at the beginning of
Yeah.
2022. And so they were wrong then. I think they're wrong now. And I think the market's going to, especially the jobs market, I think is going to have a lot more turmoil than they think, because if you strip out government jobs, which again, you got to remember, government jobs are paid for through taxation, and if everybody's lost their job, they can't afford higher taxes, and if they can't afford higher taxes and the politicians are raising their taxes, the politicians are going to get voted out. So the politicians can't raise their taxes too much, but you can't support that kind of government job growth without it. And there's just a whole complex thing that's going to happen with employment. And I think we're going to see unemployment spike more than people thought. The vast majority of the
Sadly,
Fed
yeah.
said that they thought unemployment would peak, very top at 4.1%. Do you remember where it was with last month's jobs report?
I think it was six, right?
If you look at, there's different, so there's the U3 and the U6 unemployment numbers, and U6 is a little bit higher. The U3 is what they thought was going to peak at 4.1%. And that's again, peak. They said the worst unemployment is going to get is 4.1%. And last month it was at 4.3%. And I don't think it spiked or even come close to it. So I think the Fed is just way off in their
Mm.
forecasting and their actions. So
It's a
I
shame,
think
though. I don't want to see rates in the fours because we know what that means for the economy.
it's bad. It means a lot of people lose their jobs,
Yeah.
which, yeah, we don't want to see that. But we also like, I'm in the business of, I want people to be financially secure. And I help people achieve that in large part through home ownership. And if you can lock in a long-term interest rate on a mortgage in the fours, I mean, that's such a financial
Incredible.
opportunity and such a financial relief. And it's a hedge against inflation. And it's almost like a safety blanket for your finances when you can own a home and have an
Yeah.
affordable mortgage. So while it's bad for the economy, I also recognize like the economy is going to go through cycles, but a 30-year fixed rate doesn't go through cycles. It's
Mm-mm.
it's your rate. You get into that rate, and we're blessed in the US, being Americans in our financial markets. You can say all sorts of negative things about the United States, the politics, the fiscal policies, the corruptions, the plutocracy that we're in. You could say all these negative things, but if you just go north and cross the border into Canada, their mortgage market is based on adjustable rate mortgages that go
Yep.
up and down every single year. Maybe there's some that are a little bit longer, but they're based on the market. And you can buy a home and have no idea what your interest rate is going to be in 5 years. No idea. And
Scary.
it could spike by hundreds of dollars a month, and there's nothing you can do about it. There is no 30-year fixed rate mortgage. And we have that in the US. So part of me does root for rates to come down. They need to come down from the sevens. It's
Yeah.
unsustainable. All those people that, scream from the rooftops like, oh, when I bought my first home, my interest rate was 18% back in 1982. None of those people mentioned that they paid $25,000 for their home that they
Right.
bought from the Sears catalog. Like,
Exactly.
right? You
It's
can't,
completely different.
yeah, you can't have 10% rates and home values at all-time highs at one, $1 million median price points. You have to have rates come down a little bit to sustain that type of growth because you don't want
Yes.
people to be house poor. So it's
Completely agree.
going to be an interesting ride, but I do think that in the long term and even the short term, homeowners are going to win. The most basic tenet of
Yeah.
economics is supply and demand, and we don't have enough supply to meet the current demand, let alone future demand. When we talk about the people that are living at home that are going to
Yeah.
eventually form families and want to move out and not live with mom and dad, or want to live in different areas or have job opportunities. The people that are in some of these more susceptible markets to unemployment spikes, guess what? Guess where they're going to move for job opportunities? to
Exactly.
to a market like yours that has a more or less susceptible economy
Yeah.
to economic fluctuations. So again, there's going to be winners and losers in the market regionally, but there's always opportunity for people, and I think there's more
Yeah.
opportunity when you own real estate because you can tap into equity. You're not susceptible to the whims of a landlord. You're not dealing with rent increases. You're not dealing with the home being sold to somebody else that now wants you out. Like, there's so many perks to home buying and buying sooner than later that for
I
me, it's a no
completely
brainer.
agree. Thank you so much for coming on. Again, I appreciate it. I know my audience enjoys you too, and I think this is really valuable information. I just want to mention again, if anybody wants to get more information from John, all you have to do is reach out. His contact info is in the description below. And until I see you all on the next one, thanks for watching. Thanks again, John.
All right. Thank you, Amanda. It's always a pleasure.